April 24, 1995. The sky over Brussels trembled as a sleek Sabena Boeing 747 thundered down the runway, its engines roaring a triumphant hymn for a nation that had once believed its flag could fly forever. The aircraft, freshly painted in the iconic white, blue, and gold, was a symbol of Belgium's pride, a reminder that the country's national carrier, born from the ashes of war, had risen to become a pillar of European aviation. Yet, beneath the polished fuselage and the smiling crew, a silent storm was gathering, one that would soon shatter the dreams of millions and send the once glorious airline spiraling into an abyss of debt it could never escape. Sabena's story began in 1923, when the Belgian government granted a modest fleet of 3 aircraft to connect Brussels with the colonial capital of Leopoldville in the Congo. In the interwar years, the airline grew steadily, pioneering routes across Europe, Africa, and the Middle East, and earning a reputation for punctuality and impeccable service. By the 1960s, Sabena was soaring on the jet age, introducing the sowed Aviation Caravelle and later the Boeing 707, positioning itself alongside the great carriers of the West. The 1970s marked a golden era, a modern hub at Brussels Airport, a partnership with Air France and Lufthansa through the European Joint Aviation Group, and a fleet that boasted the sleek Boeing 747-200, a symbol of global ambition. But prosperity masked structural weaknesses. Sabena's management, heavily tied to political interests, often prioritized national prestige over profitability. The airline became a conduit for government subsidies, diplomatic flights, and lucrative but costly contracts with the Congo, and later the Democratic Republic of the Congo. Its route network expanded aggressively into Africa, a market fraught with political instability, volatile fuel prices, and low load factors. While competitors streamlined operations and embraced cost-cutting measures, Sabena clung to a legacy of service excellence that required high operating costs and a workforce resistant to change. The first warning signs emerged in the late 1980s, a series of ill-timed aircraft orders, particularly the costly Airbus A340 and later the Airbus A330, burdened the balance sheet with lease payments that outpaced revenue growth. Simultaneously, the rise of low-cost carriers like Ryanair and EasyJet began eroding Sabena's market share on short-haul European routes, where price competition became the new battlefield. Internal audits revealed a growing gap between operating expenses and ticket sales, but political inertia stalled decisive reforms. The Belgian government, reluctant to see a national symbol falter, continued to inject capital, masking the airline's mounting deficits. In the early 1990s, the global aviation industry was rocked by the Gulf War, a sudden spike in fuel prices, and the emergence of a new generation of narrow-body aircraft that promised lower per-seat costs. Sabena's aging fleet, a mix of Boeing 747, Airbus 300, and older narrow bodies, struggled to keep pace. The airline's attempts to modernize were hampered by a convoluted ownership structure, a state-controlled holding company, a web of subsidiary airlines, and a complex web of labor agreements that made fleet renewal an uphill battle. By 1999, Sabena's debt had ballooned to over €1.5 billion, and its cash flow was teetering on the brink. The final blow came in October 2000, when the airline announced a restructuring plan that included massive layoffs, route cuts, and the sale of valuable assets. Employees, many of whom had spent their entire careers with Sabena, staged protests and strikes that grounded flights across the network. The public, once fiercely loyal, grew weary of the turmoil and bookings plummeted. Meanwhile, the September 11 attacks in 2001 sent shockwaves through global travel, slashing demand and tightening credit markets. Sabena's creditors, already nervous, demanded immediate repayment. On November 7, 2001, after a desperate plea for a Euros 1 billion bailout was rejected by the Belgian government, Sabena filed for bankruptcy, marking the end of a 78-year legacy. The collapse rippled far beyond the tarmac. Over 10,000 employees found themselves out of work, many without severance due to the rapid liquidation of assets. The Belgian government, forced to confront the political fallout, launched a series of investigations that uncovered decades of mismanagement, opaque accounting, and a culture of entitlement that had insulated the airline from market realities. The national carrier's disappearance left a void in Belgium's connectivity, prompting the creation of a new airline, Brussels Airlines, which emerged in 2006 from the remnants of Sabena's regional subsidiaries and the assets of the defunct carrier. Brussels Airlines adopted a leaner model, focusing on European and African routes, and gradually rebuilt trust with passengers. But the shadow of Sabena's failure lingered as a cautionary tale. Economists and aviation analysts continue to study Sabena's downfall as a textbook example of how political interference, overexpansion, and resistance to modernization can cripple even the most storied institutions. The airline story underscores a stark truth. In an industry where margins are razor-thin and competition is relentless, nostalgia cannot replace sound financial strategy. The remnants of Sabena's fleet, scattered across airports and storage yards, serve as rusted monuments to an era when national pride could outweigh profit, and they remind us that the sky, while boundless, demands disciplined navigation. Today, the echoes of Sabena's once glorious flight paths can still be heard in the bustling halls of Brussels Airport, where new airlines take off, their banners bearing fresh logos but their routes tracing the same historic corridors. Subscribe to The Collapse for more stories like this.